Welcome back, ladies and gentlemen. Thank you for remaining with us watching financial markets. And this is Smart 24. And definitely we bring you stories that are, of course, making headlines in the financial markets world, in Uganda, in East Africa, globe. Now, let's start off with Kenya. In Nairobi, the Nairobi Securities Exchange has, of course, waiver in order to excite local investors. Of course, the Nairobi Securities Exchange has begun a campaign to rev up local investors and spur liquidity at the bourse on the back of slow activities, which include exit of foreign markets, to other markets as the country approaches the electioneering period. Now, to stir up activities at the bourse, the chief executive, Mr. Godfrey Odundo, has waived daytime trading fees for the next 30 days. The bourse will also provide real-time data for the investors to enable them make quick decisions on prices. To make this thing, the Nairobi Stock Exchange announced that for a period of 1 month, they are going to give a waiver on fees to increase activation, according to Mr. Odundo. The move is meant to balance the imbalance between the foreign investors, and foreign investors control over 48% of the bourse, as opposed to 2% by the local shareholders. The Nairobi Stock Exchange intends to cushion the bourse from the risks of foreign investors who may be selling their assets due to concern over global financial recession and elections. Data shows that since 2007, portfolios held by foreign investors have been net sellers on the market, except for 2019, when they were net buyers, and this may persist. Equities turnover at the Nairobi Stock Exchange fell 19% in 2021 on decline in foreign investor appetite for shares, and they expect this to persist. Hike in lending rates in developed markets has made their investment attractive, coupled with the risk associated with the Kenyan elections, according to AIB Africa, investment firm in Kenya. Now, for foreign investors, a weaker shilling means that the value of the stock market investment is valued by changes in the currency exchange rates, and this does not favor them, since most do not insure fully against forex risks. If you take a position and you want to exit in the second leg, and you will continue paying other levies, but the Nairobi stock is free to enhance the day-to-day trading. As of yesterday, the day-to-day trading accounted for between 4.5 to 5% of the turnover, with the new move expected to ramp up liquidity, according to Mr. Gichuru. This account will also this accounts for over 983 million shillings. Day trading is preferred retail investors, as they use high amounts of leverage and short-term trading to capitalize on small price movements that occur in highly liquid stock currencies. You do not have to stick to a position the entire time, and if you feel like the market is moving in the direction you wish, you can dispose of your position, take your profit, and the only position that proceeds to settlement is the open position, according to Mr. Gichuru Joseph, who is the Nairobi Securities Exchange Infrastructure Director. Nairobi Stock Exchange will also offer free integration and consumption data until the end of this month. Mr. Kevin Jinger, an equity analyst with Jengis Capital, said balancing the local and foreign investors is ideal, as unlike local investors, they react to negative sentiments that distort the macro policy, including election, leading to capital flight. Kenyans will be going to the general elections in less than a month, with growing uncertainty clouding foreign investment flows. In most cases, this leads to the shares falling because the locals don't have the capacity to absorb those shares. However, Mr. Odunda also sought to downplay the election card, drawing from the 2013 and 2017 lessons when turnovers were low before the elections but picked up immediately after both instances. Now, that's another story there coming in from the Nairobi Stock Exchange. Of course, as they introduced last week a waiver on their, the costs for transacting on the market, and this was to attract the local investors in the country to invest, because as the statistics, of course, show that over 48% of investment is by foreign investors, while only 42% is for local investors. And this creates problems when it comes to capital flight and other things, especially when we are liquidating. We see that most of the currencies reserves actually have flown out of the country as these people liquidate and go into safer investments in their home countries, where there are fixed incomes that are quite attractive nowadays, with bringing very high returns in quite a good. Most of these issues have been put to the task the board of the Nairobi Stock Exchange, to the point of actually introducing a waiver so that they attract more local investors and quit relying on the foreign investors for market. Now, looking at the performance of the index, like we already saw, the Nairobi Securities Exchange Index, in that case, hasn't been doing that well. And of course, this has created some problems when it comes to, the market, the stock market, because most companies are seeing a loss in value, loss in, prices, value of prices is going down simply because there is a lot of selling by these 48% foreign investors who are liquidating so they can move out of the market. But we'll be seeing if this works, and definitely there have been reports that this may not have as well been that has yet seen any fruits, but it's too early really to judge, and we need to watch and see what happens next for the exchange before we can judge whether this move by the Nairobi Stock will work or not. And remember, also here in Uganda, the problem of foreign investors is still quite visible on the market, that there are so many foreign investors. And it's not a bad thing, because they bring in foreign exchange and they bring in this capital for these companies. The only problem comes in when they have sentiments of maybe making losses very soon and then they liquidate. That creates a big problem, because many of the companies will lose value on their stocks and they will be selling quite more than they're buying, and that creates kind of value there for the shares. But moving on, back here in Uganda, Stanbic Uganda is set for the first post-pandemic
after securing the regulatory approval. Now, on June 2nd, 2022, the Stanbic Uganda Holdings Limited held its annual general meeting at exactly 10 a.m. with the Board of Chairman Kato revealing to shareholders that the organization's anchor subsidiary, Stanbic Bank, had secured the central bank, the regulatory body approval, a dividend worth 100 billion for the period of 2021 and 2022 provisionally. This would be the first pandemic dividend payment, having failed to secure the approval for the 2020 dividend, as the regulator implemented measures to ensure liquidity safeguards for regulated financial institutions during the pandemic. And definitely we look at what happened, and this improves the daily performance of the market as they issue a dividend. Indeed, the annual general meeting on Thursday, 22nd June 2022, and of course, a report of pleasure to the shareholders. And of course, they shared a comprehensive update for the year ended 31st December, where they highlighted their performance, and they were pleased to report an 11% growth in the profit after tax and a challenging operating environment. And on their balance sheets, drives most of this growth remained resilient and, of course, well positioned for the growth in 2022. They also noted that trust to be the foundation of their business success, ability to create value for their investors. Perhaps the most notable outcome for the shareholders was the announcement of the payment of the 100 billion Ugandan shillings dividend after securing regulatory approval from the regulated financial institution, that is from the central bank, that is COVID-19. And of course, they were thankful for the investors who have remained patient and supportive through the last 3 years. And of course, appreciating the regulators, of course, the chairman, board of the directors, also mentioned intentions for asking listed banks, of course, to hold the dividend that, of course, led to liquidity pause and pausing the dividend as well. And so there was a lot of skepticism as people also ran away from these banks, thinking that they will never share their dividends in the long run. But they were thankful for the opportunity that the Bank of Uganda definitely gave to these institutions as they were able to issue now the dividend. Remember also Bank of Baroda as well was given a green light to go and share this dividend, and they declared a dividend of about 25 billion Ugandan shillings, which they will definitely be reaching out to all their respective investors. Now we move back to Uganda into the World Bank. Now the World Bank has insisted to its data about income status. The World Bank, of course, was contradicting with the data from the Uganda Bureau of Statistics, which declared that Uganda was already a middle-income country. The World Bank has maintained that Uganda's per capita gross national stands at $840 per annum, according to its data from 2020-2021. In a statement published on its website at the weekend, titled "The World Bank Approach to Global Income Classification," the world said that the calculation of the $840 gross national income contained in the 19th edition the economic update was based on data 2020 and 2021, which is the same reference period for all the member countries included in the current global income classification. The World Bank has carried out an income classifications since 1989 to ensure consistency and the global comparability. The current global income classifications were released on July 1st, comprising low, lower middle, and upper middle as high income countries. These classifications are based on gross national income per capita, calculated using data from the previous fiscal, according to the statement. Now, last week, the Uganda Bureau of Statistics insisted that Uganda had maintained middle income status with an estimated per capita gross national product of $1,046 US dollars. This had after the World Bank had published details in which it indicated that Uganda was still a low-income country days after Mr. President Museveni had actually published, of course, the details that during the State of the National Address in June indicated that Uganda was now a middle-income status country. Now, the World Bank has since attracted an exchange from government agencies, among them statistics, which last week indicated that there was a variance in data, in which, of course, with the World Bank relying on old data to classify Uganda. Uganda Bureau of Statistics insisted that based on its 2021-2022 data, Uganda had maintained middle-income status, a per capita gross domestic product that was within the middle-income threshold. The World Bank Group New Year begins every July, and the statement indicated that for the 2023 fiscal year, low-income economies will be classified as a gross national income per capita of $1,085 or less in 2021, while lower middle income economies will be classified with those that have a gross national income per capita of between 1,086 and 4,255 United States dollars. Upper middle income economies, the World Bank noted, will be those whose citizens earn a gross national income per capita of between 4,250 to 13,205, while high income economies will be those with a gross national income per capita of 13,205 or more annually. Now, the World Bank classifies economies into the four categories, that is the lower middle income, the upper middle income, then we also have the high income economies as well as the low income economies, and these of course give you the performance based on the gross national income per capita. Now, that is a report as well from the World Bank that contradicts the one from Uganda Bureau of Statistics, which came out recently saying that our gross national income per capita was about $1,085 contradicting the 840 US dollars per capita for the World Bank. But all in all, the country will move into a better economy, as of course very many struggling sectors of the economy have been identified with definitely in the most recent past, and this has been due to various problems and challenges surrounding the economic situation in the country, given the price inflation and the commodity price average price increasing, and also the fuel, as well as other pressures into the economy and disruptions in the logistical chain supplies, as well as also creating more imports than exports. These and more have been some of the factors that have influenced the weakening of the economy. But we hope with time these will be improved, and definitely we hope that they will go into the income status officially. Both bodies will agree that Uganda is actually a middle income status when it's actually true. And now, just a reminder, Altex East Africa, of course, East Africa together with Altex Clearing, offering you a chance to invest in the stock market with your mobile phone by simply dialing *292#, and then you'll be able to access several securities across East Africa, including the bills and bonds, as well as other markets like the equities, thereby increasing your saving, the value of your saving, and giving you a chance to trade on various platforms. We hope you had yourselves a wonderful morning, and definitely we're going to go into a break, but when we return, we have a very special guest later on, and we will be inviting one of our very own here on the show who has been, but they will, of course, give us more on what happens on the stock market. Thank you very much. We'll be going into a break, but when we return with our guests. Thank you.